Welcome to this another Friday webinar. We have been doing these webinars since 2018 beginning, and we have been learning each and every webinar very intuitively. And in that stride, we have kind of structured and planned this to understand the context of ESG. We have been talking about ESG, reading about ESG, but today the context of this webinar is trying to actually understand in depth practical aspects of businesses around ESG, not just the context, because we have seen of late, when markets fell over last 8-9 months, those businesses which were complying to ESG norms actually showed lower drawdowns. And also, if we are to kind of see in an in-depth manner, SBI's multi-cap portfolio, SBI's multi-cap PMS, which follows ESG framework, has actually outperformed the benchmark, which is BSE 500, very, very smartly. If I was to give you a few numbers over last 5 years, where the BSE 500 has given around 11% returns, this particular PMS, which follows ESG style of investing, has given 16% CAGR. So there is a 6% alpha that it has delivered. So this is a very, substantial alpha over 5 years. And all of us remember that, exactly 5 years ago, it was year 2017, which was again a very good year for equity markets. So, 5-year returns, that is why for the benchmark are only 11%. But despite that, this strategy has delivered very, very great returns. I'll give a brief background to Gaurav Mehta, who has recently joined and currently heads as a chief strategist and CIO at SBI Fund Management. And he today will take us through the entire framework on this portfolio management service, which follows ESG style of investing. He brings with him more than 15 years of experience, and looking forward to hearing from him in the first half, where I think he's prepared some presentation, and then we'll take a Q&As. Over to you, Gaurav.
Thanks, Kamal. Good afternoon, everyone, and very sorry for joining in a little late. Kamal, just to understand, how much time do I have for the presentation?
So we have ample time, around you can cover in 20-25 minutes presentation, and then the remaining half we'll do the Q&A.
Perfect. So I'll just share my screen. 1 second. Kamal, is my screen visible?
Yeah, absolutely. It's visible.
Perfect. So, just to give you some background before I go into the product and product details, I've been with SBI Funds Management for close to 4 years now. For the first 3.5 years, I was on the mutual fund side, doing research on asset allocation and lateral research, and also managing a few funds. Before I moved full time to the alternative side about 7-8 months ago. And there've been quite a few changes that we made over the last 7-8 months with respect to processes on the alternative side, with respect to the organizational structure on the alternative side, and with respect to sort of trying to institutionalize this process of alpha generation the way we've done over the last few decades on the mutual fund side, if the same success can be replicated on the alternative side. So I'll be covering some aspects of that also as we go along. But let's first directly dive into the topic at hand, which is ESG investing. Now, ESG, I think we all know, stands for environmental, social, and governance factors, right? So any organization that's environmentally conscious, socially conscious, and good on governance is ideally supposed to do well. Why is such an organization supposed to do well? I think that's the most important question. And to us, ESG is nothing new. ESG is just one thing that ESG eventually tries to capture is sustainability. And anything that we do in life, right, is about sustainability. Way that pollutes the atmosphere, it'll get a notice from the Pollution Control Board. If it's not fair to its employees or stakeholders, then obviously, those employees will quit, move on. the organization will suffer. And for that matter, if the organization is not following the right governance practices, there will be sort of capital misallocation, money guzzling, and all sorts of things, which will eventually make that ongoing concern not going, and it will eventually file for bankruptcy. So this entire repackaging of sustainability into ESG is something that may sound a little confusing, but eventually at the crux of it, it is about an organization focusing on sustainability. Whatever it's doing today or will do over the next 3-5 years, can it sustainably do that over the next 30, 50, 300, 500 years or not? I think that's what ESG is all about. And we all know that sustainability is everything in life. Whether we want to make money, if you make money in short spurts, and after that sort of lose all of it, then obviously it's of no point, right? Till that process is sustainable, it's of no point. And that holds true for investing, that holds true for businesses, that holds true for everything in all aspects of our life. So to us, ESG is not something which is, a flavor of the season or a different theme that investors need to play on. To us, ESG is sustainability, and sustainability at the core of all investing. So it's integral to investing in our view. Globally, there have been ESG, or ESG is also in some geographies known as sustainable and responsible investing. But ESG is something that's grown exponentially over the past decade or so. I think what you see here in this chart. One second. So the blue lines that you see here, the dark blue line is emerging market ESG funds. The light blue line is global ESG funds. The red line obviously is India. Unfortunately, this chart is not very updated, but I think this was updated till about 6 months or so ago, so that not a lot would have changed since then. But the essential point is that globally ESG funds have become a very large proportion of overall asset management AUMs. That trend is nascent in India, but it's catching up fast. We were amongst the first fund houses to launch ESG funds, both on the mutual fund platform as well as on the PMS platform. The PMS, for example, that I'm going to speak to you about is more than 5 years old. So as early as in 2017, we were sort of very conscious that this is something that investors will want to focus on, because sustainability is the core of everything. And as a result, we launched it then, and you'll see. I think Kamal already mentioned a bit about the performance and so on, but you will see some of that as we go along. So I think this is something that is nascent in India, but is growing very fast. Investors are warming up to the concept. And then, whatever we do, obviously we'll talk about it later, but even if you look at it at the headline index level, whether you look at there's a Nifty 100 ESG index, when you look at its performance versus the Nifty 100, there's been close to a 28-29 percentage points outperformance over the last 10 years. And similarly, when you look at the same thing in the emerging market construct, that performance has been even more stark, about 69% outperformance of ESG related index versus a generic MSCI emerging market index. So this is not just something which I think one very important aspect that Kamal touched upon during his introduction was that sustainable investing is something that helps reduce drawdowns. The reason it helps reduce drawdowns is that if you're focusing on sustainability, the chances of accidents wherein some concerns just cease to exist. When I say concerns, I mean some companies cease to exist along the line. That reduces dramatically. Any adverse regulatory change that happens, or any adverse external shock that comes through, because these companies are focused on sustainability, they are better able to weather those shocks. For example, during COVID, there were quite a lot of companies that faced a lot of labor issues. If, however, you were a company very conscious about social aspects, and as a result were doing labor management well, then obviously you were pretty immune to all that was happening around the labor shock that came because of COVID. So whenever there are external shocks, these companies are able to weather them better. And in general, at the portfolio level, accidents wherein certain companies just fall by the wayside, even those accidents are very limited, because the focus is on sustainable processes. So to that extent, this combination helps you reduce portfolio drawdowns. But the essential point that we're trying to make through this chart is that that's not the only end game. not only are you reducing these shocks and reducing drawdowns, but end on end, you're also able to outperform the index by quite handsomely. And again, this is just looking at the headline indices that already are there. I'm not talking about my fund as yet. But this is just a proof of concept that ESG investing is not just some jargon. It actually works in practice, both with respect to reducing drawdowns as well as with respect to generating alpha. Now, what we do in our ESG fund, I think it's pretty simple. And again, just don't focus on what's there on the slide because this is pretty generic stuff. But just to give you some background about how we at SBI Fund Management approach ESG. We were amongst the first signatories of UN PRI, UN Principles of Responsible Investing. We have a dedicated ESG team in-house. So we have 3 individuals that are exclusively working on ESG. We have subscriptions to external ESG rating agencies. So there are, agencies like MSCI, like CRISIL that do ESG ratings. We have subscription to those. And then this 3-member team, we also do quite a lot of in-house frameworks around ESG and try and rate companies basis their ESG practices. So to that extent, we have devoted quite a lot of energy and talent pool towards this. And, that's something that's helped us be pioneers, if I can use that word, on ESG investing in India. And then we have a partnership with Amundi. Amundi is a 37% investor. It's among the largest asset management companies based out of Europe. And they are 37% investors in us. And because of that synergy, they are again, at the forefront of ESG investing and pioneers of ESG investing in Europe. So that is another sort of dimension that helps us. So all of this put together, the ecosystem is quite conducive with respect to ESG investing. And then, from this fund's point of view, we obviously start by there are 2 or 3 elimination criteria. The first elimination criteria is a sector level elimination criteria. So there are certain sectors which are not ESG compliant, and those sectors will not touch. For example, tobacco, alcohol, fossil fuels. These are some very straightforward sectors that whatever happens within that sector, even if you have a great company within the sector, we just won't touch those sectors. So these are some sector level exclusions. The second aspect of it is, with respect to looking within sectors and then eliminating all companies which are not ESG compliant. So whether it's CRISIL, whether it's our in-house framework, whether it's MSCI, they all have certain ratings on ESG, and we have defined minimum thresholds that a company has to meet on the combination of ESG scores for us to be able to invest in them. So anything that falls below that score also gets eliminated. So first is a sector level exclusion. The second is at a company level score based exclusion. And then from whatever universe is left, companies which are within permitted sectors and which do well on ESG scores, that becomes our investment universe. And within that investment universe, we do the typical bottom investing that you would expect us to do, which is to pick high conviction ideas, companies which are very well managed from a business point of view, where management quality is up there, where growth prospects are strong, and then valuations are hopefully reasonable. Now, when I think of the entire portfolio, I think one thing which is the charm of investing in alternatives versus conventional investment avenues, in my view, is the fact that these are usually very privately placed and nichely distributed products. These are not mass products, and to that extent, sizes in many of these portfolios tend to be limited. The asset sizes that we manage on some of these strategies would be much smaller versus, let's say, what the fund house would be managing on a lot of mutual fund strategies. And that allows us 2 or 3 key advantages. The first advantage is that we can focus on companies across the market cap spectrum. So we can buy, for example, a 1,000 crore market cap company whose free float is only 250-300 crores. And we can, size it up to the extent of 2-3-4% of the portfolio. So that ability to buy good quality mid and small caps, not worry about size constraints, is significantly higher in a strategy like this. The second advantage is that we usually run very high concentrated portfolios here. So in general, in any of our schemes, we don't go beyond 20-25 stocks. So I think in the ESG fund that I'm talking about, we would have about 21 holdings at the moment. Now, when you're buying a concentrated portfolio, that allows you to size up. So you can buy each stock to the extent of 4-5%, because eventually you're just buying 21 stocks. So you have to have 4-5% on an average. And that in turn allows you to, benefit immensely when a company, which is, let's say today, a small company, is doing all the right things, is focused on sustainability, and is eventually evolving into a mid cap or large cap of tomorrow. So that non-linear journey you can participate in very well, because you're concentrated and you're sizing up those investment opportunities pretty well. And then the third advantage, I think, on the PMS side is that you don't necessarily have to track a benchmark on a day-to-day basis. Because if you're anyways buying 20 good bottom-up high conviction ideas, then you're not so much worried about what you're losing out on, whether there is some large index heavyweight that you're not buying, or there are some big sectors in the index that you're not tracking. So you're not really, it's very bottom-up in nature. You're not very worried about what's there in the index. And that allows you to deviate significantly from the index. So, once you deviate significantly from the index, you can hope for outcomes that are also very different from the index. Now, you still have to do your job well, because if you deviate significantly from the index and identify only sort of laggards, then obviously, while you look you look different from the index, but you look inferior. So your job is not just to look different from the index, but look much better from the index, and which is obviously you have to focus on identifying these stocks well. But essentially, if you just keep hugging the index, then your chances of deviating from it and outperforming significantly also reduce. So I think this combination where you're buying companies across the market cap spectrum, you're concentrating them enough, and then you're running significant active coverage versus the index. I think a combination means that you can hope for outcomes which are hopefully materially superior than the index. So as I said, we have 21 stocks today. With respect to coverage, I think between us and the index, the overlap will be not more than, again, don't hold me for this number, but it will be somewhere in the mid to late 20s. So close to 70-75% of the portfolio is very different from what's there in the index. And that, in turn gives investors some differentiated portfolio picks versus what you usually get from buying mutual funds or conventional products. And then, if you think of this, small cap skewed, concentrated position, very different from the index, we all want to do that, right? We all want to buy stuff which can give you non-linear returns and so on. The challenge is that when you buy large stocks, index stocks, you get lower returns, but you at least mentally you are secure that these are mature business models and they will not falter. But when you're buying emerging businesses or smaller businesses, the key problem that you have in your mind is that a lot of these businesses will not succeed, because the failure rate is higher the lower you go in terms of market cap spectrum. But then when you are doing that, venturing in that space, and then putting a sustainability layer, which is what ESG essentially does, then you're eliminating quite a lot of mistakes that you would make while investing in small caps. And that, in a way, gives you a very a very winning kind of a combination where you're buying non-linear stories, but you're also focused on sustainability, and to that extent, you're eliminating quite a lot of potential losers. And that, I think, is something that works very well for a small portfolio which is ESG focused. So I think that, in a nutshell, is our investment strategy. Beyond that, I think what we pick up is typically usually long-term in nature, so the churn is very restricted. And our intent is to hold these stocks for as long as we potentially can. Because, essentially, when you're buying these stocks, you're buying them to see that natural journey from small cap to mid cap to large cap, and you generate sort of non-linear returns through that journey. I think I broadly covered most of the stuff that you're seeing on this slide. I think this is, the usual bottom-up investing that we do, wherein, you try to essentially look at the moats that the business has and what is its sort of bargaining power versus competition versus new entrants versus suppliers versus buyers and so on. So I think again this is something that I'll cover in the interest of time. This I think is what is at the core of our bottom-up stock picking. So there are three aspects of stock picking. You have to identify the right management, the right business, and hopefully at the right valuation. And to the extent that we are largely looking at long-term structural ideas, important. Usually, when you have a combination of good business and good management, and you're dealing in the large cap universe, valuations tend to be a little punitive, right? They tend to be a little rich because these are well discovered stories. Everyone knows that these are good businesses and good managements. But when you're looking at good businesses and good managements, and you are not constrained by market capitalization, then as you go down the market cap curve, you find that there are great businesses, great managements, and valuations are also still fine because not a lot of institutional players have looked at these businesses because they're so small that a decent sized fund cannot buy any significant chunk of that company. So just to give you an example, right? If it's assume 1,000 crore market cap company with 25% free float. So the total float available to buy is 250 crores. But in general, mutual funds are constrained to buy not more than 10% of the market cap. So any fund house, any single fund house can at best buy 100 crores of a 1,000 crore market cap company. Now today, a lot of mutual fund sizes are to the extent of 10, 15, 20,000 crores. Now a 100 crore position in a 20,000 crore fund, even assuming that the fund buys all that it can in a single fund, will not move the needle. And I think that's the advantage of uh, investing in a product like this where sizes are niche, because you can buy those companies and size it up pretty well. And because of those hindrances for large institutions to capitalize on such opportunities, not only can you get good business and good managements, you can often get them at pretty reasonable valuations versus similar trades in the large cap universe. I think this is, essentially what ESG is. I think this is relatively well understood by now, which is that, if a company doesn't follow these metrics, with respect to it being compliant to climate rules and carbon emission rules and so on, then obviously at some point that business will cease to exist. I think China is a classic example of it. There were several industries which were uh, environmentally non-conscious, or to put it differently, that were polluting the environment, doing damage to the environment. And suddenly the regulations became so punitive that many of those industries, whether it's in chemicals, textiles, and several other metals, etc., that have now ceased to exist completely, right? So the governments almost suddenly, out of nowhere, overnight closed down those industries. And if you were an investor there, just focus on 1 or 2 years profit numbers or revenue numbers, everything would have looked fine. It's just that one fine day, everything went to zero. And I think that's something that you want to be very clearly conscious of. And the same thing can be extended, the same argument can be extended to social and governance factors as well. We know so many companies that have faded away to mediocrity because the promoters were not working in the best interest of minority shareholders. So there was misgovernance, there was theft, there was capital guzzling and whatnot. And while the business per se made sense, but because all the profits from the business were not shared with minorities but were disproportionately going to the promoters, minority shareholders never made money, share prices plunged, and these companies faded into mediocrity. So I think uh, much more important than looking at today's profit number or the next year's profit number is to analyze whether A, you will get a fair share of that profit number, and B, will the society and will the environment and will the sort of ecosystem at large will get its fair share of those profits. Because if any of these doesn't happen, then that business is not sustainable, and sooner or later it will bite the dust. I think this is just to highlight that uh, now increasingly. I mean, I think one thing that we didn't focus on so far, and I think I'll just focus on that also, is that uh, at some point, data wasn't very easily available, right? And which is why for investors, even if they wanted to do ESG investing, they're finding it a little difficult to do it in a very, because if you're covering 500 companies and doing the usual bottom up stock work and then trying to put an ESG layer, it was difficult. But now, thankfully, because data is easily available, there's analytics available, there are these rating agencies that are helping you out. You can build frameworks which need some raw data from here and there and come up with a framework. I think all of that has changed the shape of ESG investing, and that's why I think it's become much more easier for investors to analyze companies on these counts, and hence sort of eliminate companies that do not meet these requirements. Um, I think this is something that we covered already. I think what I will also want to focus on is this. While we were talking about the data piece, uh, what we also have in place is a forensic accounting framework. The intent of that framework is to weed out companies with suspect accounting practices. Because if you think of it, the single most important piece of communication between the management and minority investors is the annual report. And we've very often seen that those annual reports conceal more than they reveal, because the promoters don't want you to see the real picture of the business, and as a result, they show cash flow statements and profit and loss statements and balance sheets, which are more sort of trying to hide stuff than show stuff with respect to business realities. So we have a very quantitative framework in place that essentially tries to weed out companies with suspect numbers. And that to us tells us that if this company cannot even uh, be transparent and frank with respect to their annual reports, then there's no way you can trust these managements, and you're better off not investing in these companies. So this plays into the governance aspect of the ESG theme that I was talking about. I think this section largely covers as to there's this perception in the industry that if you were to look at PMSs and alternatives in general, you should go to boutique shops. Institutional players like, let's say, SBI Funds Management will largely focus more on the mutual fund business, and there is no way they're going to focus that much on the alternatives piece. So while it's true that we are the largest fund house in the country today on the mutual fund side, I think one thing that a lot of people would not be aware of is that even on the PMS side, we are the largest player in the country. Although most of this AUM, 10 lakh crores plus, is on the institutional side, where we run mandates for institutions. But there's very clear focus now on the retail aspect as well, because you clearly see that people are now graduating from just investing in mutual funds to looking at more differentiated offerings with respect to alternatives. And it's with that intent that, as I said earlier, I moved to this piece to take charge of the investments on this side about 8 months ago. But within the organization, we have made quite a few changes, and the most important one being this. This is what we are proposing to do, which is that if you looked at research, which is the bare bone of all the investment success in any fund house, right? That research used to sit within mutual funds, and alternatives, which is PMSs and AIS, were a little bit, out of it because there is a regulatory Chinese wall. What we are now proposing to do is to move research into a common pool, which is housed outside of mutual fund, and in that construct, that research becomes a supplier to both the mutual fund portfolio managers as well as alternatives portfolio managers like us. And that, in a way, is our attempt at institutionalizing that alpha generation that research team has been able to achieve on the mutual fund side, to be easily replicable on other avenues like alternatives as well. So I think that to us is our clear commitment to investors, that this is something that we are very serious about, and this is something where we are building in the right foundations so that investors can trust us on the alternative side exactly to the extent that they've been able to trust us on the mutual fund side for the last several years. And then we have a large investment team, and I think these are things that we're pretty much known to everyone. But the fact that apart from a large investment team, we have a very strong risk process, a risk team, we have a very strong compliance process, we have a very strong back office support. I think all of that also allows that level of institutional trust to be built for retail investors, because we sometimes come across investors where they like a particular product, they've graduated out of mutual funds, they want a differentiated product offerings, but because these offerings are coming from boutique houses, they sometimes struggle to do due diligence on the house first and then the product. So I think when a product comes from an institutional player, I think some of those friction points get reduced automatically. I think I'm coming towards the close of my presentation, but this is the ESG fund. I think I've talked a lot about why ESG is important, what's happening globally, why should in India also investors think of ESG investing, and what are we doing as a fund house on that front, and all of those things, right? And why investing in a PMS in general makes sense because of the flexibility to pay across the market cap spectrum, concentrate your position sizes, and deviate from the index with respect to what you own. But eventually, what all of this means is with respect to performance is what I think matters the most to investors. And on that front, I think I would just want you to look at the. So this is the ESG portfolio. This is the ESG multi-cap index, and this is the BSE 500 index. And you will see that if you go to on a 3-year basis, we've been better than the multi-cap index by about 7 percentage points. We've been better than the BSE 500 by close to 11 percentage points. This is on a CAGR basis. This is on a per annum alpha basis, right? Same thing if you think of it from a 5-year point of view, we've been better than the index by close to. There was no ESG multi-cap index 5 years ago, but let's say if you were to focus versus BSE 500, you were better by about 6 percentage points. And these returns, needless to say, are after you've paid for fee and stuff like that. And to illustrate what I was saying with respect to why this performance comes through because of your ability to buy small caps, size them up, deviate from the index, and so on. I think that's I don't want to sort of talk about individual names, but if you think of some of these names, Event India, for example, was a 1,000 crore market cap company till about 6 months ago. Again, 250 crores of free float. So obviously for institutions, even if they want to buy these companies, they will end up being 0.1, 0.2% of large portfolios. But for us, because of the size, we were able to concentrate it well. And again, from that going back to the business management valuation framework, this fits in very well because this is a company half owned by Murugappa Group and half by 3M. When I say half, 75% is the promoter holding, of which 37.5 is Murugappa Group, 37.5 is 3M International. And this is, one of the leading players in super abrasives in India. Super abrasives in general is something that's used as a consumable for fine manufacturing, whether that's fine manufacturing on auto, whether that's aircraft manufacturing, whether that's semiconductor manufacturing, and so on. And most of these applications in India are very nascent because we have hardly made aircrafts in India. We've hardly made semiconductors in India. We've done auto application, but again, final applications there are relatively limited. And as you see this increased focus on manufacturing in the country, people talking about indigenization and a lot of this fine manufacturing coming in, super abrasives as an industry can grow at a very non-linear pace. So I think just to give you some flavor, not to sort of talk about stocks, but this is something to say that you're buying a good business, good management, but because these companies are small, there is not that much of institutional coverage, and if you do your homework right, then hopefully these companies can do well as you go along. So I think with that, I will just end this presentation with a simple slide that what's good for the society is good for your portfolio. Goes without saying. And just to reiterate what I said at the beginning of this presentation, ESG is nothing new. ESG is sustainability, and eventually sustainability is everything in life. So Kamal, I think that was the brief that I had with respect to putting slides together. But happy to take questions and any other sort of suggestions, views that there are.
Sure, right, Gaurav. So if you kindly kind of stop the screen share.
Yes, I will.
So I think this was very detailed and one of the best presentations I have seen on ESG. And as I mentioned in the beginning, that SBI's ESG focused portfolio has actually shown lower drawdowns. Just to highlight a few numbers, over the last 6 months till 30th of June, where the benchmark fell almost 10%, this portfolio showed a drawdown of around 4.5%. And in last 1 year, where benchmark delivered kind of negligible returns, this portfolio delivered positive 10% returns. So in during tough period of last 1 year, the portfolio showed lower drawdowns, and over a longer period of 3 to 5 years, it has shown significant alpha. Over 3 years, the alpha is almost 10%, and over 5 years, the alpha is around 6%. So which is very meaningful. And as Gaurav rightly mentioned, that SBI fund management in the mutual fund business today is number one. But in the space of alternates, it is one rare PMS which actually is relatively less known. Though we have given SBI multi-cap PMS to a few of our large clients, and that is where we have practically seen the portfolio as well as the style of investing. And that is where I was keen to call Gaurav for this webinar to have a detailed discussion, and I really thank him for the same. Gaurav, while you were giving your presentation, I had run this poll, where I wanted to understand from the audience their level of belief with regards to ESG, and we have primarily investor audience in terms of, does ESG offer lower risk? Does ESG offer kind of higher return, or it offers both higher return and lower risk? And the fourth option which I mentioned was, does it offer lower risk and at the same time it lowers return? So I will tell you, 42% people actually accepted, voted for the last option. So which means most of the audience believes that though ESG may lower risk, because by following ESG you are kind of investing with ethical businesses, but following ESG would also mean that it can lower portfolio's return. And I also, when I try to understand from the point of view of those investors, kind of will agree to their thought process, because I believe when a business will focus too much on ESG, then maybe they're spending too much towards ESG may kind of limit their growth, may limit their profit, may limit their competitiveness. But obviously, in today's world, more and more money may flow to those businesses which are compliant by ESG. So, how would you address this particular question? Where there is always a dilemma and dichotomy in terms of trying to chase business competitiveness and growth, or trying to follow, ESG, and that and exactly, because you, being a portfolio manager, have to ensure that you continue to keep generating alpha, especially now in the future where we are going to see, next 3 4 5 years are growth focused era. Last 3 4 5 years were kind of low growth focused era, right? So growth was coming down, liquidity was high, but maybe that is how money was going more towards ESG businesses. But in next 3 to 5 years, growth is high and liquidity is low. So in that context, how will ESG kind of continue to generate alpha?
Right. So I think, interesting poll, and you know, it's not that for the first time that I'm hearing this question, but this is something that is pretty much at the crux of the resistance that ESG faces, which is that if you are investing today for ESG, then it's lowering your profit today, and as a result, it should hurt shareholders. But let me sort of begin by asking a very simple question that today and forever, you've seen some companies trade at 50 P's, some companies trade at 10 P's, some companies maybe trade at single digit P's, right? Why is that, right? I mean, had it only been about earnings and earnings growth, then obviously, valuations would not matter, right? Everything will trade at similar valuations. The reason people are willing to pay a 50 P for a certain company and only willing to pay a single digit P for a certain other company is because people think that not only will this earnings number that you're seeing today grow over the next several years, but it will grow in a very sustainable fashion. So I think the investor community very clearly has started differentiating on businesses basis their long-term sustainability. But to give you some practical aspects around it, right? So let's assume that there was a company who was paying ESOPs to its employees, right? Just so that the employees are better motivated and so on. And what that would obviously mean that your employee expenses might be slightly higher than another company who was trying to sort of shortchange its employee and give lower salaries and lower ESOPs to the employees, and hence boost up the profit margins. But what will eventually happen? We saw, let's say, for example, what was happening to the IT industry over the past 12, 18 months, right? There was massive attrition, because once that sector goes through an upward phase, any people who are disgruntled will obviously want to move on to the next best opportunity. And a lot of companies that struggled in this IT upmover companies, which are showing very high attrition numbers, because they couldn't retain their workforce. People were moving out. And once people move out, what do? You hire new people. There is a cost associated to it. You retrain those people. There's a training cost associated to it, and in between you lose quite a lot of business. There is a cost associated to that as well. So I think essentially when you are trying to compensate your employees well, there is a short-term pain, but there is a massive long-term gain. And that massive long-term gain for any investor will eventually translate it in through a workforce which is well motivated. Obviously, the productivity levels are higher. If the attrition levels are low, then again productivity levels are higher, and all of that will flow through with respect to future profits and future returns for shareholders. And this is something that the market knows. So the market is a very smart discounting machine, right? The market is not trying to discount what's already there in the earning number today. It's trying to discount what earnings number should ideally keep coming through year after year. And there it knows that a company with high attrition is something that deserves a lower PE multiple, and which will impact shareholder returns. Same argument you can use in several other fields. For example, if there is a chemical company who's doing all the right things with respect to effluent treatment or discharge of its waste material into the environment, obviously that will entail that there is some cost. But as I said earlier in the conversation, think of a company in China, right, who was not doing all of this, and suddenly the government regulation turned punitive. Those companies had to shut down businesses. Uh, Kamal, you have left the room, it seems. Am I still audible to the audience?
Still not able to the audience. I'm here.
Perfect.
Yeah, yeah.
Perfect. So what I was saying was that yes, if you were, for example, trying to adhere to environmental norms through discharge treatment, effluent treatment, yes, there is a cost to it, but that cost is essentially protecting you from that business shutting down completely. Once that business shuts down, then obviously investor wealth goes to zero. So, I mean, all of us buy insurance policies, right? Why do we buy insurance policies? Because we know that for that eventuality, whenever that materializes, there's a cost associated to it which you need to pay. So I think ESG investing is no different. As I said earlier, for us, ESG is sustainability. I mean, if you are not a sustainable business, then shareholder returns will suffer. And again, markets are very smart pricing mechanisms. They're not rewarding you on today's profit. They're rewarding you on what profits keep coming through year after year, and the sustainability of that growth. So from that point of view, I think it's a matter of thinking from a very short-term point of view versus from a very long-term point of view. And you can cut corners today to make your PNL look better, but that will hurt you in the future. This is like R&D cost versus operating cost, right? I mean, you pay operational expenses every day. I mean, if ESG should not be at the core of a business, then by the same logic, you can extend it to say that R&D also is a cost. Why are you doing research and development? Why are you doing advertisements? Because all of that is cost that you pay today to strengthen your franchise and make it more sustainable, right? If you don't do R&D, you will perish at some point in time because the competition will eat you up. If you don't do advertising, you don't create brands, again, competition will eat you up. So similarly, ESG is exactly that same thing, right? You are paying some cost today in order for significantly better value generation in the future. So again, just to reiterate, I don't think this is a fad that worked well over the last few years and will go away. I mean, this is the core of any investing.
Sure. So, we have seen over last 5 years, specialty chemicals sector has kind of generated best, wealth creation opportunities. And also today I see, various businesses in this industry are available at attractive valuations, as well as, they are showing great earnings. In your portfolio also, I saw Neogen Chemicals as one of the companies. Right. So, what are your views in this regards, with regards to this sector following ESG, and how much exposure do you have in this sector, and why only maybe particularly you have Neogen Chemicals?
So again, I don't want to get into too much of stock specifics, but at a sector level, yes, this is a sector which is construed as a polluting sector. But then if you look at the better companies within the sector, they are following exactly the right practices with respect to handling hazardous chemicals so that their employees are safe, with respect to discharge of waste, effluent treatment, and so on, so that the damage to the environment can be minimized to the extent possible. So our attempt obviously is that this is not a sector exclusion for us. This is not like tobacco where it's a complete no-go. But within the sector, we tend to be very specific with respect to only identifying companies where we think that and as I said earlier, right, we have subscriptions to external agencies. We have our own in-house ESG frameworks. So there again, we are checking whether these companies are fitting the bill with respect to the right ESG policies. But yes, you're right that odds of us finding good companies that meet ESG criteria in a sector like chemicals, for example, will be lower than in let's say a sector like IT, for example.
So you brought a very interesting point, in the end of the presentation where you mentioned that SBI Fund Management is trying to centralize its research, which will be common both for PMS business as well as alternates business. Now, in doing so, how will you generate that alpha comes on both sides of structures, whether it is mutual funds or it is alternatives?
So as I said, right, I mean, eventually if we get access to a much larger research pool, it's only going to add to our investment capabilities. And again, the portfolio management function still has a strong Chinese wall between the two verticals. So, even with a similar research input, people will tend to do it very differently. And as I also discussed earlier, that those three aspects where an alternative strategy like PMS is very different from mutual funds is you are not constrained that much by size, so you can buy similar stocks, but you can buy much larger quantities because size is not a constraint for you. So you can buy a small cap to the extent of 5% of the portfolio, which a mutual fund will struggle to do. Then you can concentrate, because typically we've seen that in general mutual funds, again, because of size being so large, and because they're not being able to buy large chunks in a single company, they tend to be very spread out with respect to the number of holdings. So again, here that's not a problem because you can buy concentrated holdings because size is not a constraint. And the third factor is that mutual fund is supposed to have a benchmark and be very conscious of that benchmark, versus which here you can practically be very agnostic to the benchmark, and which is what we try and do. We try to be very bottom up in approach. We compare ourselves with the benchmark because eventually investors need some milestone to measure your performance against. But when we are constructing portfolios, we are being very bottom up in nature. So the attempt is to institutionalize that alpha generation, because you have access to a bigger research team, but at the same time use the advantages that a platform like PMS offers, so that the investors get a best of both worlds.
Sure. So, while the approach is ESG, which means, you have certain do's and don'ts in terms of the target universe at the very first stage of trying to filter your, stocks in the portfolio. But eventually, the portfolio is concentrated in the PMS comprising of 2021 holdings. What are the other, if you could explain maybe, 3-4 other important factors that kind of make you identify not only ethical, but, good businesses in terms of the ideology or philosophy that we have?
Right. So usually our approach is to look at first of all companies where I've discussed that BMV framework, right, where businesses are strong. When I say when businesses are strong, that means that there is a clearly definable competitive advantage that company or its business has versus others. So to put it very simply, that there has to be a right to win for that company to do well, and it's not a me too business that anyone and everyone can replicate. And that moat can obviously mean different things. For example, for some people, moat can be being the most efficient or the lowest cost producer. For some other businesses, that moat can be a very strong brand, very strong product, very strong distribution network, and so on. Scale can be a moat in certain industries. But that's the first point, that the business has to be very strong. The second is that the management has to be very good. And when I say management being good, integrity is one important aspect of it. But that's a necessary condition. But in addition to that, you also need managements where there's, for example, skin in the game, right? Where they're motivated for the company to do well because their fortunes are linked to the company doing well. So for example, one way of ascertaining that would be high promoter ownerships. Then you need managements which are visionary in nature, right? So that not only are they thinking about what the company will do 6, 9, 12 months from now, but they're also thinking how the industry can reshape over the next 3, 5 years, and will the company be able to adapt to that industry change? Because today you're in a world where you're seeing so much of disruption everywhere. So the management has to be visionary and dynamic enough to realize those changes and adapt efficiently to it. I think those are some aspects on management. And then, all of this has to be institutionalized. So it shouldn't be dependent on a single, charisma of a single leader, right? The second layer of management has to be strong. The processes that have been put in place have to be strong. So I think so that it doesn't look like a shop where one guy is running the shop, and once you take out that guy, the shop will completely collapse. It has to be an institution where there are processes in place and where there is enough talent pool even beyond the top man. So that's the piece on management. And then I think valuations is a matter of perspective. We usually tend to take a 3 to 5 year view when we are investing in any company. And again, to the extent that you're only buying 20 companies, you're not that much focused on companies that are just about going to deliver, very anemic returns. So you can be choosy on ESG, you can be choosy on business and management, and yet you can be choosy on valuations because if you have like a basket of 1,000 companies to play from, and you just have to pick 20, then it doesn't become either or, it can become all. So I think that pretty much is the approach. But on an overall basis, we are in this funds, at least we are not so much focused on very tactical things, on trends that might play out over the next 3, 6, 9 months. We are essentially taking at least a 3 year view, and in most cases, we are taking an even longer view when we are buying these companies.
Yeah. Against common belief, where everybody would feel that ESG compliant portfolio would be large cap heavy, this particular PMS is actually small cap heavy. This portfolio has 2021 stocks, as Gaurav mentioned, with around 25% allocation to large cap, 40% allocation to small caps, and around 20% allocation to mid caps, and 10% is the cash. I am giving you these, portfolio structuring as of 30th of June. Gaurav, how is it that ESG compliant portfolio eventually ends up owning 40% large cap or 40% small cap and 20%, 20% mid cap, and maybe less allocation to large caps?
Right. So, I think that if people think that something it has a higher order of being ESG compliant, and I think I won't subscribe to that view. I think there are very good quality companies that are focused on sustainability across the market cap spectrum. And then if you think of it in terms of sheer numbers, right, there are 100 large caps in India. This is SEBI's definition. There are 150 mid caps, and I think there's a huge tail of whatever 800, 900 decent small caps, right? So to that extent, the odds of finding good investment ideas within the top 100, if you were to just start with your usual sort of criteria around ESG and good businesses and so on, finding such businesses meeting all your checklists from 100 companies versus from 150 companies versus from 800 companies, I think just by numbers and probabilities, the odds are much higher that you will end up with more small caps than mid caps and large caps. And to the extent that size is lesser of a constraint here, your ability to freely express that also is higher in a strategy like this. But to think that there aren't smaller companies that are doing the right things with respect to being environmentally conscious, being socially responsible, and being good on governance, I think it's a myth. I think there are very good small cap and mid cap companies that are doing exactly that. And I think to us, that's the beauty of this construct, which is that, you usually know that there are more winners in small caps than in large caps. The challenge is that there are also significantly high number of losses in small caps versus large caps. And then when you bring a sustainability layer, I think you are getting the best of both worlds. You're identifying non-linear ideas from small caps, and because these are sustainable businesses, you're also trying to mitigate any big mishaps. So I think that to us works very beautifully in this construct.
You have summed it really well. Is there any score that you follow in terms of evaluating companies on ESG? Because you may end up finding two companies, which are equally good, both are looking attractive. How will you kind of relatively take a call on one versus the other?
Right. So there are scorings. We have, as I said, we have multiple rankings to look at our own rankings and two third-party rankings. And for each of them, there are different. They themselves are different rating scales. So for each of the three buckets, we have defined a particular minimum rating that if anything is below this rating, we'll not buy these companies. This company has to be above a certain rating for us to even evaluate it. Within that, as you rightly said, there can be multiple companies which meet the ESG factors equally, and then we have to choose one or two of them. And therein, we'll bring in our usual sort of bottom-up analysis. So at the fund level, as I said, we have an ESG team and so on. So we are not just bothered about elimination on ESG. We in fact engage with companies also to try and see if they can improve on their ESG scores. So for us, ESG is not just about exclusion; it's also about engagement. But for the purpose of this fund, once we eliminate poor ESG companies, then we go to our usual sort of bottom-up stock picking process to choose between all those companies which do favorably on ESG, on other, and then so we bring in other parameters like business prospects, management quality, growth prospects going forward, and so on.
Right, Gaurav, it has been really pleasure conversing with you. Thank you everyone for logging in today. I think the discussion that we have done explains the practical aspects of how ESG is actually not just a fad, but a very good strategy to generate superior risk-adjusted returns, and is a norm that many portfolio managers are today wanting to be cognizant about. And obviously, we as investors and advisors also ought to be cognizant about ESG, because something which is good for society, good for economy, and obviously follows governance is something which can be relied upon, and that is exactly why drawdowns have been low during tough times. And in the longer term, as Gaurav mentioned, the choice is between trying to find a trade-off between short-term gains or long-term massive gains, and that is exactly what ESG is all about. Thank you so much today for logging in this webinar. Thank you, Gaurav. Thanks.
Thank you, Kamal, and thanks to all the audience for logging in. My pleasure.